I appreciate y'all coming out on this cold evening behind snow and perhaps in front of snow. We hear the weatherman's coming. And this is the second time we've tried this series. I know many of y'all might have come at our what we call the halftime report last summer, where we're going to try to have a series, an education series every 6 months to kind of review what's going on in our economy from the previous year. That's what the state of the markets for 2014 is what we're going to do this evening. And we're going to plan to do it again sometime during the summer to review the first half of the year. But this education series that we do is always an excellent opportunity for you to invite friends who you think would like to get some of this information. At the same time, somebody that you know who's interested in learning more about Hutchison Group is always a very professional and quiet way to get them to get to know so we can get to know each other a little better and introduce them to our practice. So before we get started tonight, I want to make the big announcement. I know everybody's been asking me about Parker. Does everybody wonder about Parker? Parker is not here tonight, but I do have this picture of him walking out of the office. He left the office as a, what's the word when you don't have a child? He doesn't have a child yet, okay? But tomorrow they're going in to induce, and tomorrow's the big day. So look out for your emails as soon as we get word, and as soon as we get a picture, we're looking forward to posting and sending it out to you. So her name's Baxley, and everything's going great, and we're just looking forward to her arrival tomorrow. So we'll keep everybody posted, all right? So let's get started. Okay, everybody want to read that real quick? Too slow. Okay, this is what we're going to go over. Putting the S&P 500 into perspective, because we're hearing about how the stock market did, okay? So we got to put what the stock market is in perspective. We're going to talk about the factors that are affecting the stock market last year, and then we're going to look at what the economy did last year, and then we're going to forecast on what we see a lot of experts are talking about what's happening coming up this year. Let's start off and talk about the S&P 500. Just a quick refresher, the S&P 500 is an index, is a Standard & Poor's, goes out and they look for the 500 largest companies in the United States. Now, it's not the 500 best companies or the 500 most profitable companies. It's literally the 500 biggest companies. So what that simply means is that's a sector when you're talking about the thousands of different companies that are in the United States. This is just 500 of the top ones. So what we heard on the news and what we see when they talk about the stock market, they always give this index. They always talk about the stock market was up today and the stock market did such and such percent today. When they talk about the stock market, typically they talk about the S&P 500. So we got to put in perspective that this isn't necessarily the whole stock market. This is just the 500 largest companies in the United States of America. The Dow Jones Industrial Average, we hear about the Dow Jones as well. The Dow Jones actually, just for all you trivia freaks out there, the Dow Jones is 30 companies. 30 companies of the 500, but the Dow Jones Industrial Average is Dow Jones. They go out and pick those companies that they believe best depicts what the United States gross domestic product is. So it's always interesting to know when they talk about the markets, because in 2014, the S&P 500 was one of the highest indexes. And a lot of people wonder, why is my portfolio didn't keep up with the indexes? We're going to talk about that. We're going to talk about our stocks overpriced right now. We look at stock prices as we measure it with the price earnings ratios, and we're going to see where we are with how their price is compared to their earnings right now. We're going to talk about, is there another correction on the horizon? That's a big question we have right now. I scratch my head all the time wondering when it's coming. We're going to talk about some things and put that in perspective. And then have we reached an all-time high? I can tell you, yes, we have reached an all-time high. Today, the S&P 500 closed at an all-time high again. And the Dow Jones is 18,200 and something today. So even today, we closed at another all-time high. This is a very busy chart, so y'all bear with me when we talk about what this chart is. This chart, all these colored boxes, goes back to the year 2007. Each colored box represents a stock index, like the S&P 500. So if you look in here, for example, where 2014, the S&P 500 did 13%. Y'all can see that if you can, but the purple is up there. It's one of the top ones, all right? But you can look at all of these. They got what they call the international markets. They got the Russell 2000. That means small companies. The bond market, the S&P value market. We can talk about value is companies that are depressed in value right now. They're not really growing. That's always sometimes a good buy. But when you put all this together, you can see that sectors change all the time. Let's take a look at it as an example. Let's look at the Morgan Stanley Emerging Markets and International right here in 2009. You can see that they both consecutively did internationally 79% and 32%. But look what happened 2 years later. Those color boxes are all the way down at the bottom. Okay, so if you were looking for the international market in 2009 and the media kept talking about, well, the international market did, you would hear that all the time. Today they talk about the S&P 500 did or the stock market did. So we can see here how the stock market did well this year. That's what we're hearing in perspective. Let's look at this right here, 2011 and 2012. You can see the REIT market did very well. 2014, the REITs did the best. But look at this year right here with the Real Estate Investment Trust, by the way. That's what REIT stands for, the Real Estate Investment Trust. Real estate, literally what it is. 2013, it didn't have such a good year. But let me show you what's important to consider and what we do at Hutchison Group when we manage your portfolios. When we manage your portfolios, we believe that you need to have a little bit of everything without too much of one thing. And let's look at what that does for you. If you look closely where it says diversified portfolio, it's hard to really tell. You can see a diversified portfolio is going to go up and down, but it's never going to be on the real extremes. What this diversified portfolio doesn't mean is your portfolio. All this is just takes a slice of each of the other colors and combines it together to come up with that portfolio. But what we want to show you is that a good diversified portfolio is designed to give you the opportunity to participate when things are well, but when the international market has a tank like it did here, you're not going to participate in everything when it does poorly either. Does that make sense? Because that's the big thing we hear when we come off of a year of 2014, when we hear about the stock market growth did 13%. In the S&P in 2013, the S&P by itself did 30%. Had really two really good years in the markets. Any questions here? Okay, anybody read this? Anybody have any questions about this? I'll email that to you if y'all are really interested, if you're having trouble sleeping at night. Those disclosures are great. Okay, let's talk about what affected the stock market last year. This is a chart that shows, if y'all can see this, hopefully you can see this okay, but the Dow started at the beginning of 2014 at 1,848 points, and it closed at a high of 2,058 points. First time it closed above 2,000 in its history, again. So overall, that year, if you go from point A in January to point B in December 31, it was up 11.39%. But if you take the line off, you see that the year has a lot of ups and downs. So let's review on what some of those ups and downs were. Early in January, the emerging market sell-off started happening. That was on the big news where the Russian ruble currency was devaluing and things like that. Going back to in July, during the summer of last year, the Federal Reserve talked about forecasting of raising the interest rates. And when they made noise about forecasting about raising the interest rates, the markets got jittery. Now, let's stop at this point and make sure we understand what raising the interest rates mean. We're going to show you a chart in a second to get into this a little more, but the Federal Reserve is trying to keep our economy. Our Federal Reserve is the bank of all the banks, okay? So if you're a bank, where do you go bank? You go bank at the Federal Reserve. So the Federal Reserve sets the interest rates to kind of determine what the market's going to do. So the Federal Reserve can lower the rates on the short-term side. And as we experience right now, and Dan can say this at Family Trust working in the credit union, CD rates aren't paying anything, right, Dan? As low as we've ever seen before. It's the craziest thing. But the Federal Reserve wants to keep those rates down so you don't save your money because it's not worth saving. So you do what with your money? You go spend it. You get loans because loan rates are down. So we have the Federal Reserve keeps the rates down so our economy can pick up and speed up. All right, that's one of the mechanisms that they have to do so. And it's been down a long time, but last summer, the economy was doing okay, and the Federal Reserve made some noise about perhaps that they were going to raise the rates, and the markets got a little jittery. All right, let's take a look at what happened back in October last fall. We heard about, remember Ebola was a big scare? And that world global market put a big scare and caused the market to have a big drop, but it came roaring back pretty quickly. Then the end of last year, the oil prices. We see how we're paying so much less at the pump right now, right? That is a good thing for our pockets, but for energy companies and stocks that use energy like Exxon and different companies like that, it's hard on those companies because they can't make the money they're forecasting they're used to. But we're going to talk about oil prices in a minute, about what that means. Very similar to low interest rates, what low oil prices, low prices at the pump. So a couple of other things to look at that happened last year. This is a slide. Some of this we talked about 6 months ago, but we can still see the trend. Employment and total private payroll. We can see here that since 2005 into the Great Recession, the Great Recession is deemed to be the period between 2007 through the beginning of 2009. During that time, we lost a lot of jobs, and we know about how the unemployment were really high. But the good news is the 8.8 million jobs that we lost, since the end of the recession, we've gained those jobs back. Okay, that's good news. The other good news is the industries where those jobs are gaining is going up. If you look close, I know this is hard to see, but I can tell you, information or IT, business services is up nicely. Manufacturing is up nicely. Leisure and hospitality and other industries up nicely. Education's up nicely. We're even getting mining and some construction back up nicely. Now, this little negative number, can y'all see who that is? The government. Okay, that's interesting how we're seeing that lag time. A lot of government entities are saying they need to restructure, and there's people who are losing government jobs. And I thought that was very interesting. The ratio of unemployed to job openings, we can see during the Great Recession how it really peaked up and got really scary. But we're back down again to where we were on average, on par, where we need to be. Now, a couple of things that I'm reading that I think is interesting. Even though we got the jobs back, wages are still not going up like they're supposed to. A lot of these jobs are sometimes part-time jobs, or they're jobs that don't pay like they have traditionally. So we still have a lot of wage pressure. That's one of the things that's kind of holding things down, even though we're getting more jobs. Any questions here? The big conversation that we're having right now is the gas prices. Now, we've seen how low it's gone. It's trickled up some. Every time I ride by the Quick Trip over at the school district office right near my house, I'm always looking at the gas prices. I think it's $1.85 right now, if I'm not mistaken. It was up to $1.89 just last week, so it's come back down a little bit. But it was actually as low as $1.62, I think. That was pretty low. That is half of what I remember it was when it was high a couple of years ago. But this is an interesting dynamic in our economy because lower gas prices means more money in our pocket. Nobody really can explain why the gas prices are so low, other than you can read things like, well, they're doing all the, what's it called, fracking? Is that what it's called? Getting the shale oil out up in the Dakotas. North Dakota is like exploding with that industry to get the natural gas out. And that's creating a flood of more fuel in our global economy, especially in the United States, so we don't necessarily depend on the Middle East. And then we also hear that the Middle East is dropping the oil prices so low, so the fracking in the United States is not profitable like it was, okay? And then you're hearing that Russia can't make money at all because what they're doing, and a lot of people they can't make money with their oil industry because a lot of people in the world don't like Russia, so they're keeping the price down to put pressure on Russia. And then you hear about this ISIS group, how they're funded, a lot of what they're doing, they're funded with oil prices. When the price is low, they can't be funded what they're doing either. There's a lot of questions that scratch your head, and all this could combine to make that's what's going on. But the other reality is, if interest rates are low, that's a lot of pressure, it's a lot of stimulus in our economy, and we're not getting traction. The next thing that's happening is oil prices are low, so we're saving money at the gas pump. That's like, in my opinion, it's like putting your foot on the gas pedal, and your wheels are spinning faster and faster, but you're slipping right now. You're not moving anywhere, but the ice under that tire after the friction is going to wear down until they get to that asphalt, and boom, the economy can take off. So that's why we got to be real careful, and that's what the Federal Reserve is very careful to make sure that we don't take off too fast. We'll talk about that in a minute. But let's look at the oil prices, see what's happened. Even as recently as last summer, the price of the pump was $3 average, nation average, $3.77, and it dropped down in December before the end of the year down to $2.63. For whatever reason, we're fortunate to be a lot less in our region of the country. Our taxes are less. But that comes off of July 2008 when we were paying, I think I might have paid $4 somewhere once, and it really frustrated me, because I didn't want to, but I had to at some point. But we can see how the gas prices have moved so much. I never thought we'd see it below $2 when it dropped below. I remember taking a picture of the gas pump of it down below $2 and putting it on my Facebook page. Like that was something, Now look at it. Now this, Harold, this is a good point about who's making the money. This is a chart that shows corporate cash as a percentage of their corporate assets. You can see at the Great Recession right here how it kind of stopped, but when the recession was over, we have, once again, their companies are holding a lot of cash. When they hold a lot of cash, at some point they got to deploy it. And there's a lot of signals that they're deploying cash by hiring people, building new things, and increasing their footprint in their regions and areas where they're going. That's going to create jobs, but the money's there. They just got to have the confidence to do it. Getting back to interest rates with the federal funds rate. This is the federal funds rate that, once again, the bank of all the banks, the Federal Reserve, they establish what the federal funds rate, what one bank, when you need money from the big bank, that's what they're charging you. So back in 2007, the federal funds rate was at 5%. During the Great Recession, to try to keep the world from falling apart, it was a scary time, it came all the way down to zero. And look how we've been at zero. This is, and we constantly see since 2008, the rates are so low, banks and credit unions, they struggle with being able to provide you with any interest at all on your money you have in the bank. So all during this time, a lot of folks are experiencing, y'all might have experienced this, what we call interest rate fatigue. I'm tired of getting nothing on my money. And what that does, it creates people when they're tired, The scary thing for me is seeing folks just go out and haphazardly invest in something without having a rhyme or reason to do it. Before we got it. When you're fatigued, often you can do something that's not very smart. So that's why I appreciate the relationship we have. Is we're here to make sure that you know if you have money in the bank, that's that constant amount of money that you need to have to take care of those emergency needs or have so you can sleep at night. It's like what we call the pillow factor money. Understanding that it's not making anything, but it has a place in your overall plan. So let's gut through it together, keep it, understand it needs to be there. But if you have more than you need, that's the conversation. That's why we talk about it. But the rates, what's going on is the forecast is we're hearing the language that they should start going up this year. Okay? Now that's where the Federal Reserve's got to be real careful. They don't want to send them up too quickly. If they send them up too quickly, that means the economy, a signal that our economy is picking up and doing well. People are spending money. We see it if y'all ride through, like Fort Mill again, back where things weren't being so crazy building, it's building again. Their traffic, we're reading about, they're having a big debate about putting a road across the Catawba River, either over on Sutton Road in Twin Lakes or Mount Gallant or Dave Lyle Extension. Those conversations are going on because of the growth and things are happening. So with those conversations that's going on, the Federal Reserve is going to need to raise the rates so to encourage you to start saving money again, okay? To stick your money to slow things down. But if they do it too quick, the signal can scare people. So the forecast is that they're not, even by the end of the year, they're not going to be any more than 1% coming off the floor of 0. So they're going to be really careful on what they do. They're going to have a meeting. They have the Federal Open Market Committee meets like quarter or bi-monthly, every other month. And I think when I was listening to Bloomberg today, they were talking about Janet Yellen, who's the chairman of the Federal Reserve. Listen to her language, okay? And everybody listens to their language. And if she says the comment about, if she takes the word patience out of her comments, and she's been saying the Federal Reserve is going to be patient about raising rates. And if the next time she talks, she said the Federal Reserve is not going to use the word patient, that means it's an indication that's going to be imminent and they perhaps may raise the rates in the June meeting. So that's going to be, if y'all are fun into that, listen to what she says, you can see what it might do to the market. But the bottom line is the Federal Reserve is attuned to keep it from going too fast, to keep it under control. Now, this slide right here shows, funny that you ask, since the last time the Federal Reserve raised the rates, what did the stock market do, the S&P 500? In 1986, when they raised the rates, the stock market over the next 8 months was up almost 35%. 1988, stock market over the next 2 years and 4 months was up almost 42. You can see what happened in 99 and also in 2004. So what happens if they raise the rates is also an indication that things are going well. The economy's doing well. Things are picking up. And the stock market is usually driven a lot by how we feel, the consumer sentiment. We're going to look at some of that in a second. The real issue in my mind about rising interest rates is not the stock market, it's the bond market, okay? The bond market is always determined, the price of a bond is always driven by what the price is driven by the interest rate environment. So imagine a bond, that pays 5% today, and then next year it pays 6%. Is your 5% bond today attractive next year? No, because you can buy a 6% bond. Your 5% was not attractive. But what if you can buy your 5% bond and you get it changed in price to make it attractive? You can buy it at a cheaper price at a discount. So in saying that, when the interest rates are going down, okay? And Dan, how long the interest rates been going down? Since the 80s? Yeah, since the 80s when I remember looking at the charts and the rates were the highest they've been. And since the 80s to today is when most of us has gotten involved in the stock market with our 401ks and all that. With the interest rates going down, the bond prices have been going up. And the bonds have always been something to offset the stocks. In other words, the stock market's going up and down like crazy. Bonds have been kind of more steady Eddie, right? That's because you look at the interest rates have been going down. We saw the chart earlier, I don't know if I can go back again, how the rates can't go down anymore. So the opposite is true with interest rates. When interest rates go up, what's the price of the bonds going to do? They go down. There could be a lot of pressure on the bond market. So that's another thing we're looking at Hutchison Group too. We're paying attention to make sure that we need to have bonds as part of your overall portfolio, but we got to make sure they're the right mixture so when this interest rates do go up, it doesn't have a real heavy negative effect. But to answer your question, Harold, this is something to know. Say just because the Fed Reserve raises rates doesn't mean it's a bad thing. Okay, let's talk about the economy in 2014. This is what I like. I'm not a big fan of debt. Y'all hear me talk about that a lot when I say it's amazing how little you need when you don't owe anybody anything, okay? Let's keep repeating that to our children, okay? It's amazing how little you need when you don't owe anything. So, but looking at how debt payments as percentage of disposable income, and that's just a fancy way of saying how much in debt was our households. Back at the peak before the Great Recession, or during the Great Recession when it hit, households were up 13.2% in debt of their overall income. The good news is we've able to come back down to a manageable level, historic level, because we as a society, I think we're focused on it. And Harold, that's another point. I believe we as a society, as consumers, aren't so into spending money and don't want to run our credit cards up anymore either, because we've been burned as a society and we don't want to necessarily do what the government's doing. We'll talk about that in a second. But this just shows that we're conscious of it. This is household net worth is finally back up again. That's the other good sign. Since the peak of the Great Recession, we had a little dip there, but we've slowly climbed back up. So our net worth is up again. That means our value of our homes are up. Our 401ks are up. When things are up like that, that creates that feeling again of confidence. So that's good news. This isn't so good news. This bothers us all. So that's why I'm hoping we tell our children it's amazing how little you need when you don't owe anybody anything. We can hope our children's going to be able to be the ones we elect, and they can help us solve this problem. But this is this is like the government's debt right here. As you can see, after World War II, our debt ran up 113% of our gross domestic product. That was the highest it's ever been. A lot of people make it sound like today is worse, but compared as percentage-wise of our gross domestic product, World War II, paying for that was where it peaked. But you can see quickly it came down. We got to the point in 1972 where it was only 24% of our gross domestic product. That was also that goofy time when interest rates were starting to go up and the economy wasn't doing so well either. And it kind of came up a little bit throughout the mid-90s, dipped down, and you can see it's back up again. The forecast is for it to be in the 70% range. In 2024, it's forecasted to be 77.2% of gross domestic product. This is a real drag on things right here. Because a lot of who owes us, as we all know, is China. And, China, they have their own issues about too much growth as well. We're going to talk about a global thing in a second. Now, this is a busy slide. I'm going to try to see if I can break this down for everybody to see this. But we talk, what economists do is they try to forecast what things are going to look at by looking at a composite index of leading indicators. Weekly manufacturing hours worked, weekly unemployment claims, new orders for consumer goods, index orders for new orders for non-defense capital goods, building permits, stock prices, consumer interest rate spreads, consumer expectations. They just put all these together and they create where the consumer, how they feel about things. Now, this is important when we ask about is the stock market going to have a correction or not. This, in my mind, shows us where we have a lot of staying power in our economy right now. But let me show you why. If y'all can see these shaded areas are recessions. Okay, this is the Great Recession we just had recently. But all the index of leading indicators, you can see right before recession happens, you can see the consumer index leading indicators are going down. Both of these times it was down before the recession hit, and this time. Look where we are right now. It's still climbing. So, that's an indication that maybe it's not so bad. So that's something to think about, how the economy still, the economic recovery we're in is still remaining strong. Let's talk about 2015, what some of the forecasts are. Here's these guys that are hold themselves out to be big forecasters on what they think they are and how they feel about the economy and the stock market. And every one of them have a positive target. And every one of them, the average, they're saying that we should have another S&P growth of 7.45. And that makes us feel good that they don't have any other reasons not to think of something. But we always have these issues that can come up that we don't anticipate either. So the Federal Reserve summary of economic projections from fourth quarter to fourth quarter of 2014, 15, 16, 17, and forecasting the long run, the change in our real gross domestic product, if you see, is forecasted to be slowly, long run average 2.2, but gross domestic product is always, the economists like to see our gross domestic product be in the 3 to 4% range growth a year, 3 to 4%. That's not too much and not too little. It's just good, steady growth. Like an example, China, back a decade ago when they were going gangbusters, they were growing at 7 and 8 and 10% a year. And they're trying to digest all that today as we speak. The unemployment rate, the unemployment rate, y'all remember at the Great Recession, if you do or don't remember, it was almost in double digits, okay? So it's down to 5.8, and their projection long run is going to be 5.4. The inflation index, you can still see the inflation index is still tame. They're still keeping it calm. Inflation, once again, is the cost of goods going up. There's a lot of concern about cost of goods actually could go down. That's called deflation. See a lot of that overseas, like in Europe and China right now. But for our inflation, it looks like it's still going to be a good steady pace. But this is the Fed funds rate that we mentioned earlier. It's at the floor right now, and perhaps throughout the end of this year, it could stay at the floor. By the end of 2016, predictions 2.5 to 3.63 and up to 3.75 in the long run. Be honest, this is the reality. If our Fed funds rate can be above zero at enough cushion so they can raise and lower it to get the economy sped up again. Right now, we can't lower it anymore to help speed it up. We got to wait it out. And that's kind of what we're going through right now. Okay? So, once again, the federal funds rate aren't projected to go up way high to kind of slow things down. It's going to be a very slow trajectory upward. Here's a great slide that I like to, it's important for us to step back and remember and look at in the long run of what the S&P 500, the 500 largest companies in the United States. The first, you can see where it has a plateau, a little this, another plateau, a little climb, a little plateau, and here we are right here. Over time, we have what's called cyclical cycles, secular cycles that, like from 1900 to 1924, it was pretty flat. We had the Great Depression and things got crazy. Another flat time until World War II was over. Nice steady climb, another flat plateau. And this is when we're talking about how the interest rates were really high during 1974. Interest rates coming down, stock market goes up. Interest rates are at the floor. They're only going to go up. We're at a flat plateau at this point right now. We're still considered a plateau and haven't broken out of that yet. So looking at this historically, that's a case that the market's still on a good run. This is an interesting slide that talks about what the stock market does during presidential cycles. Right now, we're in a third year of a second-term president. The first year, you can see since 1949 to 2009, it's up and down. We have some negative years. Second year, some up years and some negative years. But look at this third year where we are now. There's one negative year in 47, but most of it's pretty steady Eddie. The fourth year of last term presidents has some pretty scary down numbers as well, but there's another indication that if you look at that, it may not be as bad either. But this, they called, before we started 2014 was supposed to be the year of recovery, but the reality, 2014 was the year of divergence. Divergence meaning that we're not on the same path as the rest of the global economy right now. We're doing well, we're recovering, and the rest of the world is not doing so well, and they're still lagging and going through their issues. But this busy chart right here, the S&P 500 and Europe and the rest of the world minus Europe, which is the Pacific Rim and all that, China and Japan. So we look at those numbers, we see how the Pacific area is really hurting. Europe is doing okay, but here's us in the United States, and even over time you see it just goes up and down as crazy. But the global economy, it just shows how right now we're going one direction and other countries are going in others, and that can always flip-flop. For example, Brazil is they're at a part in their economy where their interest rates they're at a high interest rate environment right now. Well, here's the United States. We're at the bottom. Our interest rates are starting to climb. New Zealand's are ahead of us. Mexico, they're trying to lower their rates right now to slow down things. Europe, you've seen that's where they are. Europe's behind us with Australia and Canada. They're trying to slow down their economy by getting their rates down speeding up their economy by lowering the rates down. So we're kind of, you can see how we're kind of ahead of the curve there. So this is the big question that kind of wrap things up. Through this year, for 2015, either we're going to kind of get stuck in place, called stagnation, or we're going to get that traction where that wheel spinning and catches the asphalt and takes off and has a lot of heavy inflation, and it can be a detriment to our economy. Whereas there's a lot of factors to try to keep everything in moderation. And moderation is the Federal Reserve trying to measure when to start raising the rates, but not too high. And maybe that, like a lot of other things in our economy, like the gas prices are starting to come up a little bit to kind of slow things down as well, but still allow us to enjoy spending that extra money we have in our pockets. So, but there's no single solution. There's no magic pill, and that's what I want y'all to go home with to understand or be enlightened to understand. Even though we hear on the news about something that worked great last year, does not mean it's going to work great this year. We've seen all that. It's all about understanding that you got to have some investments, as we do with our portfolios for you. This is called passive management. And passive management is the kind of investment when you buy an index of something and you hang on to it. The other is active management. And active management is where somebody's actively selling and trading, forecasting what the economy's doing. And the other is tactical asset allocation. Tactical is that buzzword that simply means when the sun's shining, you want to be exposed to catch the sun. But when the storm clouds are coming, you want to have a mechanism to be tactical to protect yourself. We also want to make sure we're efficient with our investments, tax-wise, because if you have money invested that's not in your retirement plan, if you monkey around with it too much to try to make money or protect it, it creates tax issues. So you want to be as efficient as you can. Then you also, as that chart we showed earlier, you want to have every color, okay? Not just one color. And then once you have Diversification within asset classes. That's another important thing. You want to have energy stocks, but you want to have Exxon and you want to have BP, for example. Then you want to have global diversification because we know what's happening overseas and that roller coaster, some's coming up, some's coming down, so you got to be involved in all of them. And you got to also understand what's the buzzword these days called alternative investments. Many of you in this room are involved where Parker and I showed you those real estate investment trusts. That's a new program going on where it's not a stock. It doesn't do what the stocks do. It doesn't do what the bond market does. It's an alternative investment that's really doing well right now. So it's good to sprinkle some of that in there. Insurance, legacy planning, long-term care. That's one thing that we've recognized, that if anything can mess up the best laid out plan in the world for our clients is if one of the folks in a two-couple marriage has a long-term care illness where they need help and medical expenses. Many of y'all probably have stories of parents, of your parents or grandparents, and how devastating it can be. Insurance also to ensure that you never run out of income. Have cash flow insurance. There's lots of reasons to mix some insurance in there to protect what we have as well. And lastly, estate planning. That's where one day at some point, we know we're not here, we're going to leave something to our kids. We want to plan how that's left to our kids in a tax efficient way. We also want to make sure it's in a way it's not detrimental to them either, so they don't spend it all at once like winning the lottery. But the bottom line is, every one of you are different. And I'm so blessed to have the opportunity to get to know every one of you, to understand what's unique in your world. So Parker and Debbie and I can take all of this to create what's unique for you. Because there's no one solution. And there's never going to be one solution. It's hard to imagine going through life today and making all those critical financial decisions that you have to make without some help. And that's where we appreciate the fact that we can step into your lives and help you do that, be in front of your mind. Well, I hope y'all enjoyed your light refreshment. Okay? And I look forward to seeing y'all soon. Thank you.